you're setting yourself up for more risk than needed over however many years because there's no guarantee that this product will be around in 3 to 5 years. That's what everyone should be looking at, not the headlines of where the Fed chair thinks the rates are going to go. Sooner you get comfortable with this, and this is what I've been telling clients, the sooner you get comfortable with this and take advantage of where the market is now, you will get better deals than when everyone else starts to realize that this is where we're at. Buying a real estate property is beyond just the transaction of buying it. Once you own it, you're actually in deeper trouble and deeper headaches than when you were doing the transaction. The transaction is the easy part.
All right, so listen, tell me, you guys are in the capital game. You've helped thousands of people with Convoy home loans, but the question I have is, there's people that are crushing it out there in the real estate game, and they're crushing it because they have access to capital. They figured something out that a lot of the others haven't. Because, with Private Money Club, our platform, we deal a lot with the private lenders. And what we're seeing is a lot of private lenders are lending money, and then the investors aren't able to get out of that private loan, which is creating issues, foreclosures, defaults. They can't get permanent financing. I know that's an area you guys specialize in. What is going on, first off, with the people that are crushing it, that are actually winning the game right now versus the ones that are not? That's question one. But also, what is going on in the economic landscape? I know the Fed's tightened. It made it really difficult for people to get money. Like, how are you seeing all of that? I mean, with your size and scale of your lending company.
Yeah, absolutely. Obviously, like I said, we started the business 5 years ago. Dustin and myself, I usually have a partner with me. We've been in the industry for 12 years, so we've kind of seen. We haven't seen an actual crash, right? But we've probably seen micro crashes, right? Little 2016 where rates kind of, you probably remember 2016 rates kind of did a little jump.
Yep.
2020 we had an absolute just spike up in rates, and then we had a shoot down in rates, and then back in 2022 going into is starting inching up. 2023 hit a peak, right? So like we've kind of been through these ups and down cycle wise, and I think where the people are crushing it right now, right this minute, in terms of getting capital and making sure that they can reallocate the funds and recycle it, because the name of the game is once you get the money, you reuse it, repeat, rinse, recycle, like constantly, right? The people that are crushing it are the people that are buying the property right the first time, right? They're doing a little extra more due diligence in the beginning, making sure that there's as much of a margin that they can build in the beginning, right? So if they're buying, let's say, something for $150,000, right, as a purchase price, and instead of getting, making buying it at market at $150,000, they're potentially buying it for 120, right, 110, trying to give themselves a 20, 25, 30% margin on when they're buying it, because you only buy it once, right? So the people that are really crushing it are the people that are building in that extra margin. Now, the other people that are crushing it are people that are not leveraging too much, right? And private money, it's very easy to over leverage, right? And you know this because the expansion of like loan to cost, loan to values, they'll typically go a little higher than normal traditional lenders would do, right? So the people that are crushing it are not over leveraging to 92 and a half, 95% of total cost, right? There may be scaling back to be 80, 85% of total cost, and making sure that the exit, whether it be a refinance, whether it be a sale, that the ARV that they're working off of is less than 75% of the ARV, LTV of the ARV, right? I think that's where a lot of people are. You open yourself up to the most amount of opportunity to either exit one way or the other without losing, your butt on a over leveraged type property. Like to your point, defaults have been rising, right? And defaults have been rising specifically in two places that we've seen. I mean, we kind of already saw the wave of Airbnb defaults hit the market, right? And that already kind of didn't really fully leave. We're still kind of at the tail end of it, I feel like. But the premiums that used to be there for Airbnbs no longer exist, right? On when you're buying. Now the next default that's coming is the people that are stuck in higher leverage properties that
Mhm.
are unable to exit the property, right? And that's because they bought it with too tight of a margin, right? They wanted to put as little down as possible up front and get the loan that would get them the most amount of leverage up front, instead of being like, Private money is a tool, not my lifeline. I think that's where people get lost, right? And that's where that separates kind of the winners and the people that unfortunately fall behind, right? And you've probably seen this yourself in
A
your
lot.
community with people. There's the people that are winners where they're like, okay, it's a tool for me. It's not, I'm not doing it because I have, only $10,000 to put into this property and that's it, right? It's, I have, 100, 200, $300,000. I could buy this thing cash, but I'm using the power of leverage to be able to multiply and use it better than someone that's like, I only have 10 grand, I need to only put 10% down, 5% down, whatever is on the property, and then over leverage themselves to put themselves in that position, right? So I think that's kind of the separation of the people that are crushing it and not crushing it. The biggest difference, I think it's a mental thing as well, right? Because you have to mentally prepare yourself where maybe you're not ready, to and have that hard conversation with yourself of maybe you're not ready to buy something, right? Maybe you're not ready to do, a private money loan, because a private money loan is, again, it's not supposed to be something that you can't exit from. People that issue private money loans they don't want to foreclose on you, right? That's not the goal. The goal is, let me find good people that I can continue to rinse and repeat my money as well. That's how private money lending works, right? So putting yourself in the best position, buying it the right way, doing the work to do that is what creates the differential. In terms of the market in whole, right? Rates have kind of been, and it's crazy to say this, stable, right? Over the last, I want to say 6 months to a year, we haven't really seen like crazy shots up, but we also haven't seen crazy shots down, right? What is happening in the real estate market, for especially in regards to mortgage rates, is the margin compression in between treasuries, like the long term treasuries, 10-year treasuries and whatnot, and 30-year mortgage backed securities and actual rates. So usually there's a bigger margin in between those two. And the Fed's lowering the rates because they're always talking about the federal funds rate, right? So there's that difference between the two. Federal funds rate is overnight bank to bank lending. Think short term loans, think car loans, credit card rates, that type of stuff,
Mhm.
right? Student loans. When we're talking about mortgage rates, we're always talking about a longer term loan, right? So even with, because there was a little bit of a headline that was created with Trump calling Powell to buy $250 billion worth of, treasury bonds, right? And that was not necessarily pointed towards a long-term treasury bond buying. They were buying shorter-term treasury bonds, right? Which did have an indirect positive effect on long-term treasuries for a very short period of time. But the reason it was so short-lived is because overall, big picture wise, right, the mortgage market is following the long-term treasuries. So 10-year treasury is probably the closest tie, right? And the 30-year mortgage-backed security is the closest tie to mortgage rates. When that goes up, you know that, okay, rates are probably a little worse. When that comes down, rates are probably a little better, right? So that is what is kind of being the up and down, not necessarily Feds are cutting rates, mortgage rates should be lower, right? It doesn't work that way. So I think that's the common misconception of where the market is rates should be lower, but it's actually kind of flat. And you've probably seen it yourself too. But again, what we're seeing is a margin compression between the actual mortgage rate and the treasuries, in which case that used to be bigger, which is why in reality, treasuries haven't moved that much year over year, but mortgage rates have slightly come down. And that's not fully because the Federal Reserve said we're cutting rates. It's because it's just a tightening of the compression of the margin, right?
Yeah, and some
So
speculation as well.
exactly.
There's a little bit of speculation and I would call it front running a bit,
Hmm.
built into some of these rates. That's more of a competitive advantage. Everybody's trying to be competitive in the space and have, a better rate or a better offering, for certain products. And I think you're seeing some of that. But that was a really good explanation. I think a lot of people do think as soon as Powell comes on, drops rates, they think they're going to be able to go get a mortgage cheaper. And I love how you explained that. It's really more tied to the 10-year treasury. And that really that can be said about a lot of things. I mean, in the insurance world that we're in, everything is pretty much tied to, the LIBOR bond index and the 10-year treasury. I mean, that's just your benchmark for how rates are handling. But, the average public, they watch the news, they hear the rates came down, they think all of a sudden they're going to be able to get things cheaper. And in short-term stuff, maybe, but not 30 years. Now, let's talk a little bit about your bread and butter, which is DSCR. A lot of people don't understand DSCR. Can you just give an explanation of DSCR loans, what they're really targeted for, and who they benefit?
So DSCR is debt service coverage ratio, right? And it's actually not a new concept, right? And it's
No, it's been around forever,
it's
but
yeah,
actually,
it,
better question for you.
yeah,
Why is it that everybody throws DSCR? Because you're right, it's
yeah.
nothing new. It's the same crap that's been around forever, but that's just what all of a sudden it's got this new name. Like, what was that all about?
It's because before the product was used for commercial, right? Anything above 5 units was on the debt coverage chain, right? So anyone that was transacting with the banks on commercial underwriting, with where they were factoring in vacancy reserve, they were factoring in, expenses, they were factoring in management, like all that stuff was factored in. They calculated that in the debt coverage ratio, right? And the debt coverage ratio was rents over the monthly payment. So if it covers or doesn't cover, right, the comparison of the two, of the actual rents of the property along with the actual expense of the property, including the payment, is what was being calculated. Now, the reason why it got so popular is because, call it 4 or 5 years ago, because we were actually one of the first major brokers to bring this to market. 5 years ago, we were writing these things 40-year fixed, crazy, 3.125, right? Nuts, insane world, while everyone else was doing the investment and the conventional, trying to do that stuff. Now, looking back at it, that was the best time, but that was also when the market was trying to figure out what DSCR was, right? And now we have a lot more institutional money in it, which is why it's so much more popular. But it is essentially just for a residential loan, which is 1 to 4 units, just the gross rents versus the actual gross payment. That's principal, interest, tax, insurance, and if there's association dues. But that's it. The comparison between the two is how you qualify. So, who is it built for? Built for anyone that, or two people. One, you're self-employed, you make a bunch of money, and you don't file good tax returns. Then you don't look good on paper.
So, in
So
other words,
instead of
almost every real estate investor.
100%,
There we go.
right? You take all the deductions you can, you take all the write-offs you can. I always tell my clients, Uncle Sam will take from the front, which is taxes, or he'll take from the back, which is when you try to get a loan, right? So he's gonna take somewhere. So where a lot of investors were getting cut and a lot of self-employed people were getting cut was when they try to apply for a conventional loan, right? Sorry, can't do it. But I have $1 million in the bank. Sorry, your tax returns don't say anything, right? So to fix that problem, they rolled out and institutionalized the DSCR loan for residential properties, which is why now it's bigger because there's a higher volume of trading that happens for residential versus commercial. So now more normal, real estate investors that write everything off on their taxes don't need to show tax returns, and they can qualify just based on the actual qualification of the property, which is the property doesn't make money, and what's that making money percentage over the actual expense of the property, which is not including, unlike commercial, no vacancy reserve, no other expenses, no management. It's just principal, interest, tax, insurance, and association. That's why I call it the gross payment, right? So gross rents versus the gross payments. If that meets as 1.0 at least, like 100% coverage, you're good, right? A little below that, there's products for it. But should you really be buying that asset at that point? I don't know, right? So it depends, right? In per strategies, that's kind of the differential. Um, it's also great for people that are trying to get into the investing game, right? That have maybe a nest egg that they got from, a family member or someone else that they were like, I don't really want to go into the stock market and invest in the stock market. I want to put it towards real estate. But you don't have any real estate investing experience in terms of your tax returns are kind of not as strong. Um, and let's say you're a student coming out of college, but there's a lot of kids that I deal with right now these days that have family inheritances they've received of a lump sum of money, and they're like, hey, how do I how do I put this in? I don't have a job yet, right? So this is kind of a good avenue to put and invest like the money that they've received into real estate without having to be like, how do I underwrite with conventional underwriting on whether a deal makes sense or not, and if I can qualify. It's also great for investors that want to put things in LLCs, right? LLCs, S corps, trusts, something else that doesn't report on your personal credit because it keeps it off the personal credit and creates a clean chain of title of just ownership of the entity instead of ownership of the personal.
That was a phenomenal explanation.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
So I got to ask this question: with DSCR becoming like a mainstream thing and, lots of people using that, and rightfully so, it is a better fit for the investor world. Where do you see the problems with this? If we go back, 2006, 7, things got loose there, things got out of hand, then there was systemic risk in the banking. And then all of a sudden we had the great financial crisis, if you will, the Great Recession. Do you see anything like that happening with where we're at right now in the cycle?
So there were three times, and anyone that just recently entered the game won't know this, but there were three times in the last 5 years where DSCR went away. Residential DSCR went away. There was no offering because what happens is a lot of these products are sold on Wall Street and to hedge funds and insurance companies, right? So it's a demand type product. It's not like a conventional loan that is 100%, it's always going to be bought by Fannie, or 100% it's always going to be bought by Freddie, or like an FHA or a VA loan that's going to be bought by Ginnie, right? So it's not like that. These products are actively traded in packages of 30 million, 100 million, a billion, right? And these institutions are buying it as hedges for returns on their risk, right? So they're buying these. The moment they stop buying, the program's gone because it's not a federally backed program. So that is the greatest risk, is if the market goes crazy and let's say Wall Street or these hedge funds and these insurance companies all of a sudden say, we don't really want to buy these products anymore, we want to just go back to the more traditional stuff, then overnight this product is gone, right? There were a lot of lenders that lost their books and just closed down in the last 3 years because they went to market, try to sell, let's say, a certain rate bucket, and the way these trade are on weighted average coupons, right? So they package up like 7% with like 6.25 with like 5.875, and then they weight average together. This is a weighted average coupon. This is what I'm trying to hit, right? So right now in the market, everyone wants to hit like a 6.75 or a 6.5 weighted average coupon. That's what Wall Street wants to trade these things at. If let's say they all of a sudden say, we don't want that anymore, we want a 7% return and a 7% weighted average coupon on the bond buying, on the debt buying, then that whole bucket of multiple billions of dollars that was in that 6.5, 6.75 is worth nothing.
Wow.
So if that happens, then it's again not Fannie, it's not Freddie, it's not Ginnie. That's when these like things kind of go belly up in terms of now there's no market to sell it to, right? And um we've originated so much of these types of loans, and we've seen so many lenders go in and out of the market just because we're seeing all these trades happen on the secondary market. Like there's lenders that are aggressive and we're going to go hard, see what sticks, be at the lowest rate possible, and then maybe a year later they won't be around, right? So that is the greatest risk to the product itself. But in terms of now that institutions like Goldman Sachs, JP Morgan, these big names are buying these products, I think the risk level has gone down a little bit of like, will the product disappear overnight? But it's a reminder to everybody that there's always like, the music has to stop eventually, right? And it's not like it's a constant going and buying. So I don't know. Over the last 5 years, it's exited 3 times. There was a point where we were like one of the last brokers to offer it because they just cut everyone off. They stopped. And the rates when we were offering it were in the high sevens, low eights, and that was a good deal at the time. And so who knows what'll happen, right? But that's kind of the inherent risk to the product. Um, However, that's why I tell a lot of clients too, if you're buying something on this product, if you're trying to do this product, it's a great product. It's a tool, right? Just like private money, it's like another tool, right? But it's not the lifeline of how you should be like investing. You need to make sure you're buying a good deal. You have to make sure there's equity built in there. Make sure it cash flows, and you don't want to put yourself in a position where if this product goes away and let's say you do like an arm product instead of a 30-year fixed product, which for this type of asset or the DSCR loans, I recommend 30-year, right? But let's say you do a 30 instead of a 30, you take a 5-year arm or a 3-year arm, you're setting yourself up for more risk than needed over however many years because there's no guarantee that this product will be around in 3 to 5 years. Who knows? Right. So long story short, that's the risk.
Oh, that's good. That's really
Yeah.
good. And one of the interesting things you said a couple things that I want to unpack there. I want to hit the rate lock products that were very common, in the last boom, I guess you would say, especially with flippers. But I really want to talk about like how you guys have grown so fast. I mean, in your space with all this turmoil and all these people coming in and out, and that it is. It's kind of like fly by night. But you guys over the last 4 years have grown tremendously, thousands of clients. What do you attribute your success to? Because I mean, that's pretty phenomenal.
I appreciate it. I mean, I'm a man of faith. So first foremost,
Love it.
I
Me too,
say
man.
God, right? So I really truly think that it was his oversight onto our business in terms of so his fingerprints everywhere. So I can't say it's anything we did myself, right? But for anyone that's not a believer, right, the answer that I would give is the I think it's just niching ourselves out earlier on, right? It's like the Warren Buffett method of when everyone is selling, that's when I buy. When everyone's buying, that's when I sell, right? So when we started 5 years ago, everyone was think back, it's almost six now, but think back to 1.75, 2% 30-year fixed, 2.75 30-year fixed. Like everyone was chasing that, right? And myself and my partner Dustin knew that m- music was going to stop eventually.
Yeah, that was
And
a
we said,
fairy tale.
we have to figure out a way to adhere to and like help other people that's not just the conventional buyer. So that's why I say we were one of the first brokers to bring DSCR to market because we did DSCR, we started doing more bank statement type products. We started doing more like other types of products that don't involve just the conventional method. And so because of that, because of what we did 6 years ago, now like if the conventional market ever comes back to where it was before, we can pivot back, right? But we almost don't want to because we enjoy working with real estate investors and self-employed people more, right? Just because they have more insight and a lot more experience with the market themselves. Um, that's the whole that flip of the switch of we're going to go against the crowd is what allowed us to I think grow to where we are today.
Yeah, the
Yeah.
path less followed. Yeah, and you're right. God has a big hand in everything we do as long as we have faith and we believe we can do it and we put the power in him. Um, with that, another thing I want to talk a little bit about with your successes is it sounds like you've kind of gone the more conservative route to growing. I know a lot of people, especially in the capital space, it's easy to chase the dollar. It's very easy to kind of get blinded by who you are, what you're really trying to build, and then go after the short, the quick dollar, if you will, I guess is what you would call it. How do you think that's played a part in your industry, with different lenders where they're just chasing what pays them the most? And then tell me a little bit about like how has that served them?
So we Dustin and myself, the way that we built the business is on relationships, right? And a lot of people will say relationships but they really mean like how much will you pay me, right? In a transactional relationship. We try to steer away from that a little bit, right? We've done loans for $0, right? To keep a good relationship. And we've done loans where the client's happy to pay us money to do the loan, right? So it's like that's kind of the main thing that we focus on. A lot of people, what I've seen is, and it still goes on today, is just because the client doesn't know what's out there, right? Just because of that. And maybe the loan officer or the broker, whoever's trying to offer the loan, also doesn't know what's out there, but they're a little too lazy to do their own due diligence to help the client get a better deal. So they will just push a product that puts clients into a difficult position, right? High rates, long prepays for forever, right? And then offering things that don't exist and then putting them in positions where the client is now left with no options, right? At that point in time. So a lot of those people we've seen exit, but we've also seen a lot more of them come back just because the rates have kind of, come down a little bit. Um, but I think we like to try to be as advisory as possible and try to have that relationship right built in because we put the transaction is the bridge to build that relationship, and then we want to be the go-to for whatever anyone's doing. You're buying a primary house, good. We want to be a go-to. You want to buy an investment property, here's a 10 different ways to buy it, right? You want to buy it with seller financing? Great. Here's how you can do that too, right? So, like structuring different ways where we have a full vertical stack of this is, we're home for whatever you need for anything real estate, right? And by creating that kind of relationship, I feel like we've had a lot of success in just repeat customers coming back and back and back. And then also we just have what I've seen, and I'm not just saying this just because to say it, but like we generally have the best terms on the market, right? And the reason for that is one, we do a lot of volume. So lenders and aggregators that like sell these loans, they'll take less of a margin on our loans, right? Because we do so much more volume. So they want more of our business, just like clients want the best rates when they're looking around, they want the best brokers too to work with. So they will give us a little bit of incentive there, right? So we, instead of taking that as a profit, send it directly to here's the lower rates for our clients to be able to qualify for something better, right? So we have that set up. And then we also have, it's not just us and myself, right? We have a full staff of people to help take the loan from start to finish. So you have a question, you can call, whoever your loan officer is, or if you're calling Dustin or myself, we're picking up no matter what time of day it is, right? Because we know that it's important to the individual. And then we also have a full staff of people that you can ask questions to. You can, walk with. They can walk you through even the simplest things. So I think that's kind of like the whole situation around what we've done right versus what I've seen other people, unfortunately, that have gone astray do not as well to retain, clients' best interests.
All right. So with that, I want to go back to what you'd mentioned. You guys mostly do DSCR, but a really prominent product is the ARM. And when I was really big into real estate, doing all of our flips, we almost always used community banks and we did ARMs. Usually it was a 5 or a 7-year rate lock, and then it reset. Now, this is pretty commonplace in the business world and definitely in the real estate investor world. But a lot of investors are getting crushed, especially syndications, large multifamily, because back in the heyday that you kept mentioning, the fairy tale land, when we could get rates around 1 to 3%, they were gobbling these things up with zero really due diligence being put into the fact that in 5 to 7 years, where's the rate environment going to be? And while inflation, COVID, money printing all jumped rates up. So a lot of these loans, when they came right to that point, that 5 or 7 year arm, they started to reset. And these weren't small resets. These people were going from 3-4%, which they built their entire business model around that 3-4%, and they reset at 7-8%, which it's like a doubling effect. So no matter what your numbers were, you're out the door, and you can't just jump rents up to make that happen. How much have you seen this? How big of an issue do you see this being as we kind of go deeper and deeper into this, if the Fed can't drop fast enough, which I don't think they're going to? The new appointed Fed chair, he's clearly made a state that, that they're slowly going to bring rates down. They're not going to just aggressively start doing 1 point cuts. So, what is your thought on that? And what impact do you think that's going to have on real estate investors, portfolio holders, and so on?
Yeah, I think a lot of people that got hit by those adjustables either got shut down by foreclosure, right? Already, or they had to already put money in, right? So a lot of the refinances that happened ended up being cash in refis, not cash out, or even just wrapping everything in. People had to bring in 400,000, $1 million, to refinance these debt into debt coverage positive positions again, right? So those people, I feel like from 2020 and 2021, 2022, like that already kind of happened. And a lot of these, it's the dust is kind of settling, right? But you hear the headlines of, like, for example, we're in Los Angeles. So, downtown Los Angeles, building sold for, 400 million, 4 years ago now, and then it just sold for like 130, right? So like that trade has silently already happened, and the crash of the crash, in quote, air quote, of commercial real estate has, I think, already kind of taken place a little bit. Um, but in terms of the new Fed chair and where the rates are going, um, I think the most important thing, and I try to point everyone back to this, is the bond market, right? And I think what people are not realizing and are maybe starting to think about is how powerful the bond market is, right? If Trump's scared of anybody, he's scared of the bond market, right? Because the bond market is where rates either go up or down, right? And anytime, like for example, if the bond market, if everyone was saying that, okay, Trump's going to appoint someone new that's going to push his agenda, right, to lower rates, great. That in theory sounds great. However, the Fed chair is not the person that controls mortgage rates. So now, what controls mortgage rates? What's affiliated with mortgage rates? We're looking at back at bonds, right? And if you look at the bonds, when even when Powell got indicted once, like sued and start like, hey, you're going to get indicted for investigation, bond market didn't like it, right? Trump appoints someone new last week, and then it rolls into this week. What happens to the bond market? It's worse, right? So the bond market itself is kind of an indicator of, whether they like or think that rates will, the effect should be positive or negative, right? That's what everyone should be looking at, not the headlines of where, the Fed chair thinks the rates are going to go. And by the way, if you look at every Federal Reserve meeting that comes out, they send out the release notes prior at the minutes. You'll see on there, there's something called the federal dot plot chart, right? And that's something that a lot of people look like, people like you and me will look at it, but the common person doesn't. But I feel like that's an important chart to look at because it tells you where the Federal Reserve thinks that Federal Reserve rates should be over the next 3 years and on, right? And we are within the range of where they think it should be going 2026, 27, 28 and on, right? Over the long term. So to expect mortgage rates to drop by a full percent, 2%, 3%, down to where we were in like the 2 to 3% range is, I don't want to call it impossible,
It's not
but
going to happen. We can
it's
both say
unlikely.
that. It's
Yeah,
it's not even unlikely. There's just no way they're going to allow that to happen.
correct. Because again,
It's not healthy. I mean, people
the
need to understand that is
yeah,
when rates are that low, like you might think it's a really good thing because you can
yeah,
buy a house cheaper. That is a really, really bad thing. It means there's major fundamental problems in the economy and
yep,
in the markets that we don't want to go back there. Actually, I'll say this, and a lot of the listeners that are waiting for low rates aren't going to like this. Where we're at right now is actually a pretty good place to
yeah.
be. Maybe we could come down another point, quarter, 0.5%, but I would even say that's going to start signaling some serious fundamental issues. But where we're at, this is the norm. This is
Yes.
the healthy place. Like
Yeah.
find comfort in that. But I know, they don't look at it that way, and
Yeah.
they're not going to.
The sooner you get comfortable with this, and this is what I've been telling clients, the sooner you get comfortable with this and take advantage of where the market is now, you will get better deals than when everyone else starts to realize that this is where we're at. So, and that's the thing that I want to have sink into people and listeners and everybody is, you know, get comfortable with these. Do the work at these current rates, and they're not bad, right? Like we've been writing a lot of DSCR loans right now in the fives, right? Like 5.5, 5.375, 5.25. Like people are buying it down to just keep it and set it and forget it. Like if you're underwriting in the fives and you're underwriting in the low sixes, like that's a good place to be. No matter what happens to the market, you can be confident that you have a good rate and that you can ride out all the way, right? And that's kind of, I think, the long-term effect that you need to have so that you don't end in these situations. What we brought up earlier and you brought up earlier was the arm situation, where what happens if it adjusts? What happens if you're, 4% that you had before jumps to an 8%, right? How do you fix that problem? The best way to mitigate that is just do a long-term debt, and then just not think about it. Think about how you can improve the property, how you can multiply your money instead of worrying about how am I going to get this property to cash flow again now that the rates jumped 4%. Yeah.
Wow, well said. So, listen, folks, as you're listening to this discussion we're having, and you can tell we're not just talking to all of you listening, we're just having a discussion. I'm learning, I'm trying to understand, what people on the inside are really seeing, because obviously we're looking at the micro and macro economic viewpoint of where we're at in the cycles. And I'm just kind of wondering, all right, what are you seeing on your end? And like literally everything that I would, think is happening, you just concurred the same. And I love that. But a lot of people need help in this. They need to refinance. They've got properties they're looking at. They need capital because I think you guys say this a lot. You say capital shapes an investor's life. And I couldn't agree with that more. So how would people go about working with you guys to look at their deal, to help them? I don't want to say coach because that's a bad word, but just help guide them the right way so they don't make poor decisions, buy a property that's going to get them in trouble. What are the best ways for people to work with you?
Yeah, you can go to convoyhomeloans.com and let us know you came from the channel, or we are on the Google Play Store and Apple App Store. So if you look up Convoy Home Loans on either of those platforms, you'll see our application pop up. You can download it, do the application there, or you can do it online. But you just go on there and let us know you want to talk to Dustin or myself, and then you'll know that hey, you're getting the owners, you're getting the full service, you're getting the full experience of knowledge that we have to help guide you in the right direction.
All right. So one thing I want to say is a lot of people like you heard that, but you probably didn't write it down because you're driving. So we're going to put that right up in the description. So no matter where you're listening to or watching this podcast episode, you can just go up there. We'll have all the links so that you can book a call with Jonathan and his team. And I don't want to leave your partner out. I know he's on a plane, but Dustin, was going to join us today. So you're either going to get Jonathan, Dustin, or one of their team members. But just a wealth of knowledge. Really, I love the way you articulated that in your space. No disrespect to your industry, but there's a lot of shysters, a
Yep.
lot of fast talkers, a lot of people that are just going to say anything they have to say to try to get you to fill the application out. And a lot of them charge a fee just for the application. And they get, the investor gets in it and all of a sudden they realize, wow, this isn't what I thought this was going to be. But you guys are not doing that. And I really commend you for that. But that's also the reason why you guys have grown so much. So again, I know I gave you props earlier, but kudos to that you've done something that very few other businesses in your space, in the capital space, have been able to do and successfully maintained that growth. So that's amazing. But anything that you want to say to this audience before we call it quits for today?
Yeah, yeah. I think the main thing. Thank you so much for having us on. But also the main thing is like, make sure you do the work, right? Make sure you learn how to do the work yourself. And by do the work is don't just go with what people are telling you is the hype and the way to do it, right? You have to actually learn and understand how to, whether you're using private money, right? Making sure your loan to cost calculations are correct, making sure your budgets are correct, or whether you're buying it on a new property that you're trying to do a cash flow on, right? Really understand what it takes because buying a real estate property is beyond just the transaction of buying it. Once you own it, you're actually in deeper trouble and deeper headaches than when you were doing the transaction. The transaction is the easy part. So I think this is kind of a mindset shift for a lot of people. They put so much emphasis on like the loan to buy it or how to buy it instead of thinking about the repercussions of what comes after they buy it. So that's why I'm saying do the work up front so that you're making sure you're buying a good deal. My rule of thumb that I like to do again, 25% max of the ARV if you're buying it on a bridge. Try not to over leverage and put too little down on the equity. Like really try to set yourself up for success instead of failure.
Man, well
Yep.
said. Hey, thank you so much for coming on. What an
Thank
honor.
you.
And keep up the good work. And folks, again, up in the description, you'll have all their information, their website. We'll put that link up there, the calculators, all of it, whatever you need, book a call with them. But hey, thanks for joining us for this episode of Money School Elite. And you know what? We'll see you on the next one.